Welcome to S&P Capital IQ's quarterly update on the leveraged finance market in Europe. I'm Ruth McGavin, a member of the Leverage Commentary and Data team in London. I'm going to tell you about how the European leveraged loan market fared in the fourth quarter of 2015 and how it compared with the scene in the US, before giving you some thoughts about what might lie ahead. Let's start by looking at new issue volume as a marker of success or otherwise. Fourth quarter loan issuance in Europe amounted to 14.6 billion euros. This is fairly slow compared with the first two quarters of the year, but it was an improvement on the very feeble third quarter. If you focus on the dark blue in the chart here, showing institutional issuance, you can see that there was in fact a decent level of activity. Arrangers pushed ahead with syndicating their deals, despite outbreaks of volatility in the wider markets, especially in the US, and a couple of larger corporate M&A transactions, including Avago and Swissport, helped to lift volume. But even the valiant efforts of the European market in the final months of the year could not close the new issue gap versus 2014. By year-end, European new issuance reached 64 billion euros, a disappointing 19% down year-on-year. M&A financing overall was down on the year, as was opportunistic financing. But sponsor-backed buyouts reached a full-year total of 21 billion euros, a 16% rise on the 2014 tally. During the fourth quarter, Europe was influenced by its own internal technical drivers, which were neither very supportive nor very weak, but also by the poor sentiment feeding across from the US market. In Europe, repayments were too sluggish to compel a heavy institutional investor bid in the fourth quarter, but CLO creation gradually improved after an extended post-summer lull, and Europe also had a long lineup of CLO warehouses open in the background. Combined with a persistently keen bid from retail banks for European credit, this meant there was a stable bid for new assets. Buyers were choosy, certainly, and arrangers had to improve terms on numerous deals, but essentially the appetite was there. Over in the US, the technical picture was woeful. This can be attributed to weak repayments at a time when a string of large transactions launched and heaped up supply. Sluggish CLO issuance throughout the second half of the year and sustained mutual fund outflows meant that demand simply failed to keep pace. This was reflected in the average bid of the US flow names, which lost 320 basis points during the fourth quarter alone, compared with just 80 basis points loss for the European flow names. As a result of that prevailing weakness in the US secondary market, returns on European loans comfortably outstripped the US for full year 2015. The S&P European Leveraged Loan Index, the ELI, registered 5 consecutive months of market value losses from July to December, but it still managed to close the year with an overall gain of 4.6%. In the US, the S&P LSTA Leveraged Loan Index, on the other hand, made an annual loss for only the second time in its 19-year history, closing the year at 0.7% in the red. So, in the fourth quarter, the two markets were walking in the same sort of direction, but by no means exactly in step in terms of secondary performance and technical drivers. However, pricing on European new issuance rose on the same trajectory as in the US, as borrowers in both markets found they needed to pay up. In Europe, the clearing yield for single B-rated TLBs climbed by more than a point from its second quarter low to reach 5.77%. This came in a combination of a higher spread over the base rate, plus increased use of Euribor floors, plus a deeper average discount to par as arrangers responded to market conditions by flexing wider in many cases. In one notable instance, Veritas, flex was not enough, and the jumbo financing had to be postponed. But this was more as a result of lack of takers for the dollar piece than for the euro, according to market sources. Indeed, there were other high-profile deals, including Swissport, that rebalanced their financing request towards the European market in order to fill out their books during the quarter. Now to look ahead. In the near term, there is a lively calendar of deals lined up to hit the European market in the first quarter. These include the likes of WebHelp, LGC, Eurogarages, Armacell, Solera and many more. so it doesn't look as if supply will be a problem in the early weeks of the year. Foretelling M&A activity is always a bit of a foolhardy endeavour, but some arrangers are remarkably hopeful about a flow of assets coming up for sale, and they believe that equity sponsors' chances of winning could be better, or at least no worse, than they were last year, now that the public equity markets have lost their edge. On the demand side, the expectation in Europe is that the CLO market will revive thanks to refreshed appetite for AAA paper. Although, with the US market more richly priced, it's to be expected that some non-CLO fund managers will be focused on that market at Europe's expense. In terms of clearing yields, it feels unlikely that European credit will tighten significantly unless the US market does likewise. Cross-border syndications will need to offer matching or nearly matching relative value between dollar and euro tranches. But market sources say that even on domestic European syndications, the borrower may have to stay in touch with what's being offered out of the US and in the high-yield market. However, issuers will look to make the most of the cheaper cost of financing currently available in Europe, which could help boost supply to the market in the first quarter. This brings me to the end of the market review. I hope you found it useful. Please feel free to email LCD with comments or questions. You can also download the slides at slideshare.net. If you'd like to know more about the leveraged loan market, you can follow LCD on Twitter, Facebook and LinkedIn, or you can visit our free websites leveragedloan.com and highyieldbond.com. The links are all in the info section on our YouTube channel. Thanks for listening. I hope you'll join me again next time.